there are a few things we still need to talk about that haven't come up. One is that frequently counties and cities operate landfills, all right? And that's an enterprise. They, of course, charge money to use the landfill. The garbage collection uses the landfill, and they charge people to pick up the garbage. So one thing we have to think about is can't use these landfills forever. And at the end of its useful life, we're going to have to, take care of it and make sure it's not making pollution and things like that. So cities, counties, whoever's keeping track of the landfill, states, they have to keep track of some post-closure costs. So the costs have to be estimated and accrued, and every year you set aside some money to close down that landfill. So here's the transaction. Post-closure expenses, so it's an expense, so it's a debit, and liability for post-closure care is a credit, and we're not going to learn how to do this, but obviously in real life you have to estimate how much you think it's going to cost to close that thing down and take care of it. Of course, there's obviously tables and information to get that. And then, so once it's closed, how do you take care of it? Well, obviously you're spending some of that cash, so you take it out of the liability for post-closure care account, and cash. Of course, cash is what you're paying out. All right. So some governments may put them over in governmental activities, and in that case, that same idea will appear in the government-wide statements, but you still have that same periodic expense. So the proprietary fund has its own separate set of statements, which you may recall. Statement of net position, which is like a balance sheet. Statement of revenues, expenses, and changes in fund net position, which is like kind of a combination income statement and retained earnings statement. It's where you calculate the new net position. And a statement of cash flows, exactly like it sounds, divided into 4 categories, not 3. So we do have some statements that go with that. So the statement of net position does have your assets and your liabilities, but unlike our typical balance sheet we're used to, assets minus liabilities equals net position. No equity. Assets are classified just like we classify them at a company, and government classifies assets and liabilities as current and non-current. So they don't have quite as many categories as we might, but current or non-current for your assets and liabilities. And down in this net position part, so assets minus liabilities equals net position. Down in net position, you may recall this from chapter 3. 3 subcategories. You'll report your net position for unrestricted funds, restricted funds, and net investment in capital assets. So you have 3 subcategories under net position. Kind of like how under stockholders' equity we might have common stock, paid in capital in excess of par, and retained earnings. So you could have 3 categories in stockholders' equity. It's not that big of a deal. Same idea. Like an income statement and changes in retained earnings statement, we have statement of revenues, expenses, and changes in fund positions. Because this is not net income, right? It's not like we're here for profit. But we do track our revenues, we do track our expenses, and we do track not changes in retained earnings, but changes in fund net position. So you take revenues minus expenses equals operating income, minus anything else, gains or losses from things that went on, minus capital contributions and transfers equals your change in net position. Then you add your beginning net position, which gives your ending net position, which is what goes over on the balance sheet in 3 categories. We do have a cash flow statement The cash flow statement, if you go take a look at it back in chapter 3, has 4 categories. Still has operating, still has investing, but now financing is subdivided into 2, capital related to financing and non-capital, capital related financing, so capital investments, purchasing things, capital financing, and non-capital, just short-term loans and things. So that's a slight difference from what we're used to. So there are several things that are different. So just a real nice quick comparison chart to help you remember. And I think we talked about this before back in chapter 3, it was. So a regular FASB compliant cash flow statement can use direct or indirect. Typically, if you were to go pull some company, Target or Walmart or Apple, pull their financial statements, their cash flow would be indirect because they want to disclose less. All right? Out here in the government, they always use direct for cash flows from operating activities because they want to disclose more. That's the point of government financial statements, is it's the people's money. We need to tell them what we're doing with it. So that's one big difference, is it uses the direct method, which we're not really that used to. We're a lot more used to indirect method when we get into the operating activities. Interest and dividends are in the operating section for a regular cash flow. In the governmental cash flows for an enterprise, they're in the investing section, which makes a lot of sense to me because they're from investments that are not capital investments, right? Interest and dividends in a corporation, they're from current assets, so that makes sense. Interest payments are in operations, whereas in a proprietary fund, interest payments are in capital or non-capital financing, because that's what you're financing with it. Purchases or sales of long-term assets are investing. So if you'll recall, your equipment, your building, stuff like that, that's paid cash for, that's investing, because you're investing long-term in this equipment. But fixed assets are in capital-related financing. And the reconciliation of income and cash flow starts with net income, whereas reconciliation of income and cash flows from operations starts with operating income. So big difference there. So proprietary funds go off to the government-wide statement. So if you were to go look at a government-wide statement, you'd see them listed in the column business type activities. Right, so think back to chapter 3 when we looked at our government-wide statements, and we have the governmental and then the business, right? So all of them kind of get included. So the whole set of funds just get included in one column in the government-wide, and it's called the business type activities column. And you don't have to do any adjustments. So with the governmental funds, we have to do some adjusting entries to make them conform to the accrual-based accounting, which is how the government-wide statements report. But business-type activities are all being reported on accrual basis anyway, so we don't have to have that little reconciliation. Internal service funds are governmental activities, and so they're going into the general fund on the government-wide statements. And again, you don't have to reconcile them. Their assets and liabilities go. Only revenues and expenses for an outside sale go in the statement of activities. So here's kind of how it works, right? So your government-wide statements are up here, right? And so we have a statement of net position, a statement of activities, if you recall that. And so to get there, we're doing transactions down in the funds, right? And then we come up with our financial statements for the funds. The governmental activities, which, because they're accounted for using modified accrual, we have to stop and do some adjusting entries before they get entered into the government-wide statements. You've got your proprietary funds, which include the enterprise funds and the internal service funds, which get combined with the governmental activities before they go on. They don't need the reconciliation because they're not in modified accrual, but they still get combined with the governmental stuff and then go to the government-wide. The enterprise stuff just goes right up to the statements. And we're going to skip Chapter 7 because those are the fiduciary funds, and they don't go on the government-wide anyway. So, why? Because they don't belong to the government. Those are things like pensions. My pension belongs to me, but I'm trusting the government to keep it, right? So that's how those two funds get combined. The governmental, the proprietary get kept separately all year long. The end of the year, we convert this governmental from modified accrual to accrual. We take the internal service fund and add it to the governmental stuff that's been turned back to accrual. Then they go on the statements, and then the enterprise funds just go up there under business type activities. And now you've got your funds, your statements that show you everything that went on, but not the fiduciary funds. You have to get a separate fiduciary fund financial statement and look at that. And they're always part of the financial report from the government. You can look those up. You would be able to see if they've got your pensions that kept. All right, so that's it for this chapter. Remember, we're going to skip Chapter 7, so the next chapter is Chapter 8.